Hi everybody, I hope you're doing great. Today we're going to pick up with adjusting entries. Now, we learned in the last video about accrual-based accounting. And for those of you who are in the Monday, Wednesday, Friday classes, just so we're clear on what we're doing here, this is video A for class 10. Alright, so for Monday, Wednesday, Friday classes, you have another video to watch for class 10. For the Tuesday, Thursday classes, this is video 7B, so this is the second video for your class number 7 on Tuesday, Thursdays. And we're just getting into the adjusting process. We know we do accrual-based accounting, which means we need to record our revenues and expenses in the period in which they occur. So that means maybe cash didn't even change hands. Or maybe it changed hands in the past. Maybe we got cash up front and we did work later. Maybe we have used up some supplies, and even though we paid cash for them a year ago, we're just using them up now, so we need to expense them now. So we're putting the revenues in the correct period when we actually earn them, and we match our expenses to those revenues as we're using up our expenses. So that's what adjusting process is about. It's making our accounting match what's actually happening during the period. So you can imagine that during the period we've been keeping track of the transactions. You all have gotten really good at posting those debits and credits. Sorry, let me get rid of this. At posting those debits and credits as they come along. But now we're at the end of the period, the month, the quarter, the year, whatever, fiscal year, and we need to think about, well, are there any revenues or expenses that we haven't considered yet? And there usually are some revenues and expenses that we need to get in our accounting records. So that's what this is. We're going to adjust the books to reflect those additional revenues and expenses. And there's some pretty standard types of adjusting entries, so it's helpful to think systematically, like, okay, every month I need to sit down and think about these types of entries. Do I need to make any? So we'll talk about the types of adjusting entries. Like all of accounting, there are some categories, so you just memorize those categories and figure out what goes in them, and you will be doing great. So let's start talking about adjusting entries. Okay, now, I'm sure you all remember the trial balance that we did at the end of Chapter 2. There was one on our exam, and the trial balance merely takes all the accounts, puts them in a list, debits on the left, credits on the right. We see if at the bottom of the column they balance. Now, what we did in Chapter 2 was actually an unadjusted trial balance. Because Chapter 2 we hadn't learned how to do adjusting entries yet. So the trial balance that we did for Chapter 2 was unadjusted. So that's great. You have to do that before you start doing your adjusting entries. You don't want to start doing adjusting entries to an out of balance trial balance. So let's talk about that. The trial balance that was generated in Chapter 2 is generally referred to as an unadjusted trial balance. The unadjusted trial balance is incomplete because it omits various revenue and expense transactions in the account balances. The adjusting journal entries record use of assets, the change in liability accounts, and/or recognition of revenue or expense items. So that just means that we're going to sit down at the end of the month after we do our trial balance and think about, well, are there any revenues we haven't got on the books yet? Are there any expenses we haven't got on the books yet? Did we use up some assets that we need to record in our accounting records? So that's what adjusting entries are. Now, just like everything in accounting, there's some categories. In this case, adjusting journal entries come in two categories: deferrals and accruals. All right, so there are two types of deferrals, right? So deferred expenses and deferred revenues. Deferred expenses are often called prepaid expenses, and deferred revenues are often called unearned revenues. Deferred revenues represent payments made by customers prior to when the services are performed or the products are delivered. So deferrals means something got paid up front, right? So think about an insurance policy where you pay 6 months up front. You've prepaid that expense, right? Think about that unearned revenue. I know we've talked about it. Unearned revenues are not revenues yet because we owe them the work, right? Remember we said that unearned revenues are liabilities. So a deferral, a deferred expense or a deferred revenue means somebody paid some cash up front, and now we need to adjust for that because we either did that work or we used that asset up and now it's an expense. Then there's this other category, accruals. Accrued revenues are revenues that have been earned but for which the cash has not yet been collected. Accrued revenues are the opposite of deferred revenues with respect to cash. Deferrals refer to any transaction where cash is involved prior to the recognition of an expense or a revenue. Accruals refer to any transaction where cash is involved after the recognition of an expense or revenue. All right, so these deferrals, that means, hey, we've paid somebody's paid some cash up front, and accrual means, well, the cash hasn't been paid yet, but you know what, we actually earned that, or we actually used that expense. So, that's the two categories. And I think as we start to do some transactions, maybe it will make a little more sense. But it shouldn't be too difficult. There's two categories, right? Accruals, deferrals. And each one has expenses and each one has revenues. All right, so let's talk about deferred expenses first. So remember, deferrals mean somebody exchanged some cash up front. All right? So, deferred expense is an item paid for in advance by the company for use in the future. The payments are considered assets rather than expenses until they are used up. When the prepayment is used up, the used portion of the asset becomes an expense via an adjusting entry. So, in a deferred expense, the situation's going on is some cash got paid up front by your company. So your company knows it's going to owe rent, so they pay that up front. Your company you're doing the accounting for knows they're going to have to pay some insurance, so they pay several months up front. So these are very common. It happens all the time. Typical deferred expenses are prepaid rent, office supplies, and depreciation. Although depreciation doesn't involve cash, so kind of keep that in the back of your head. All right, well, let's just look at one of these entries, and hopefully that will be a little clearer. All right, so we're going to talk about prepaid rent. So remember, this is a deferred expense because some cash got paid up front. All right, now back in transaction 10 in chapter 2, so if you look in chapter 2, all those transactions we talked about, you may recall that Smart Touch Learning prepaid 3 months of the lease on its building, paying $3,000 or $1,000 per month. The initial entry required a debit to prepaid rent and a credit to cash, right? So up front, this is not the adjusting entry. This is when the cash changed hands. So obviously every time cash changes hands, you're making some kind of an entry. So what happened was in December, they prepaid $3,000 of rent. So prepaid rent is an asset. That's something that's going to have future value. Prepaid rent is an asset because it has future value. So they paid cash, so clearly we credit cash. We got this new asset, prepaid rent, on the books. The initial entry required a debit to the prepaid rent current asset account and a credit to cash for $3,000. This represents that Smart Touch Learning has the right to use the property for the next 3 months and as such records an asset on the balance sheet. Each Smart Touch Learning will adjust the prepaid rent account for use of the facilities. All right, so here it is. We put the $3,000 on the books on December 1st. So we have 3 months worth of rent now, prepaid. It's an asset. Well, what happens? A month goes by, right? By the end of December, Smart Touch Learning has used 1 full month of the rent previously paid. Right, so we paid 3, we've used 1. The allocation for the 1 month is $1,000. Remember, 3,000 divided by 3 months. As assets are used, they are converted into expenses, which is rent expense in this case. At the end of December, the remaining balance in the prepaid rent asset account is $2,000, which is found by taking the original prepayment of $3,000 less 1 month usage of $1,000, which equals $2,000. At the end of January, the same adjustment will be posted to show another month of rent. So, what that means is, if you look back, we put the prepaid asset on the books, $3,000, there it is, sitting there. We got an asset, $3,000. But at the end of December, well, a whole month has gone by. We've used up a month's worth of rent, right? I mean, nothing really happened. We haven't exchanged any more cash or anything, but, well, we've been using the building for a month. So we don't really have that part of the asset anymore. It's no longer prepaid. So we need to reflect that in our books. And it's rent expense. So we just go rent expense, debit, right? Expenses are always debits, right? Rent expense, and then prepaid rent. That's a credit. It's reducing that asset, prepaid rent. So that's an adjusting entry. We just sat down at the end of the month and we said, okay, what expenses do we have that aren't on the books? Oh, we used up some rent. Let's reflect that. And that's all it is rent expense and prepaid rent. Let's think about another kind of deferred expense. So, supplies, right? We talked about how supplies are an asset, but supplies expense is an expense. Well, how does that happen? Obviously, you're not going to buy one paper clip every time you need a paper clip, right? You're going to go out and buy like a case of them. Same thing with paper. You're going to buy a bunch of cases and put them in the copy machine room. And you're just going to buy a bunch of office supplies. And depending on what kind of office you have, some of those supplies can actually be pretty expensive. So you buy a bunch of supplies and you use them up over the course of a month or however long of a period. So that's supplies. So you're going to have prepaid supplies, and then as the month goes by, you need to record how much of them you used. So that's what this is. So our example is on December 31st, unadjusted trial balance for Smart Touch Learning shows a balance in office supplies of $500. This represents the amount of supplies that were purchased earlier in the period. All right, so back earlier in the period, we bought some supplies, put them in the supply cabinet. Assume the ending balance of supplies is $100, which was found by counting the office supplies on hand at the end of the month. Since there are only $100 of supplies left on hand, the company has used $400 worth of supplies, found by taking 500 minus 100, right? So obviously, every time you get a new pencil, you don't write down, minus 50 cents in the accounting journal, right? So you buy some supplies up front, put them on the books, right? Prepaid supplies, or just supplies and cash, right? You've got them, they're on the books, supplies are an asset. Then comes along the end of the month. So you go, well, how much supplies do we have left, right? And you go, oh, we have 100 left, so we must have used 400. So that's great. So we need to record that expense of $400. So in order to increase the expense, right, we debit it. So we increase supplies expense by debiting supplies expense. And of course, we no longer have those supplies, so we have to debit the asset supplies for $400. That's all. That is just another example of that. All right, so here's a special kind of adjusting entry we call depreciation. All right, so let's think about this up front before I start reading the notes. So you think about something that's used up over a long period of time, like a building, a vehicle, furniture, things like that. Long-lived tangible assets, right? All right, so obviously when you buy them, you put them down on your books as an asset, right? You pay $1 million for a building, so you know, asset building, debit, asset cash, credit, right? Because you've paid for it, right? So you put that building on the books, but it's an asset. But clearly you kind of use up a building over maybe 20 or 30 years, right? Same thing with furniture. You don't keep furniture forever, but you probably keep it for 10 or 20 years, right? So you've got these long-lived assets that you're paying money up front for, but it doesn't really seem quite appropriate to expense them all in that one period, right? I mean, yeah, you spend $1 million for your building, but it's not just for that 1 year. You're going to keep using it. So you don't expense it all at once. You expense it over time by taking depreciation. All right, so that's what we're doing here with depreciation. Most prepaid adjusting journal entries are related to the adjustment of a current asset account, right? So current asset would be like supplies, rent. However, long-lived tangible assets are also used in the operations of the business. They act much like other prepaid assets, except adjustments will be made to the plant assets over a number of years instead of 1 or 2 years through depreciation expense. Depreciation is a type of prepaid expense adjustment. Plant assets are recorded in full at the time of purchase. Therefore, an adjustment is recorded to reduce the value of the asset over its useful life. The prepaid adjustment for plant assets is called depreciation. So plant assets, it's similar to deferred expenses. It can be considered a kind of deferred expense, but it's over a very long period of time, right? Imagine $1 million building being depreciated over, say, 30 years or 20 years or something like that. So we call that depreciation. So we're just using up a little bit of that asset over time. So let's look at that. Here's an example how we got an asset that's long-lived. All right, so in Chapter 2, on December 2, Smart Touch Learning received a contribution of furniture having a market value of $18,000 from a stockholder. The original entry included a debit to the furniture account on the balance sheet and a credit to the common stock account. Assume the furniture has a 5-year useful life. Okay, so we've got $18,000 asset furniture. Furniture doesn't last forever, so we know we're going to have to expense it in some way. So we're going to take depreciation, and this 5-year useful life is important because that's going to help us figure out how much to depreciate. All right. Depreciation is usually defined as the periodic, systematic allocation of the cost of a long-lived tangible asset to expense over its useful life. When recording depreciation, a debit is made to an expense account called depreciation expense. Under generally accepted accounting principles, land is never depreciated. Residual value, R-E-S-I-D-U-A-L, residual value, is the expected value of a depreciable asset at the end of its useful life. Straight line depreciation method is a method used to allocate depreciation expense each year over the useful life of the plant asset. For now, we will not calculate depreciation using the straight line method. You will be given the dollar amount for problems. So what that means is we have a useful life, right? In that last example where we were talking about furniture, we said 5 years, right? So that's the first step of depreciation. You have to go, okay, well, how long is this thing going to last me, right? Because you got to figure out how long you're going to divide that expense out over. Then you figure out, was it going to be worth anything at the end? Because if it's still worth something at the end, I don't really need to depreciate that, right? So you've got useful life and depreciable value. Now, I don't want you to worry too much about straight line method right now, even though this chapter talks about it. For your problems and for your exercises in class, we're going to give you the depreciation amount. We're just going to say your depreciation expense is $500. All right? So, let's talk about recording the entry. All right. Recording the entry for depreciation. This is it. Depreciation expense, which makes sense. And then there's this other interesting account, accumulated depreciation furniture. All right, so let's talk about that because that's a brand new concept for us. The adjusting journal entry records a debit to depreciation expense of $300 for the 1 month the furniture has been used. The corresponding credit is accumulated depreciation for the same $300. Every plant asset will have its own corresponding accumulated depreciation account. The book value for the furniture as of December 31 would be $17,700, which is the original cost of $18,000 less the $3,000 accumulated depreciation for the month. So you'll see, obviously, whenever we have a debit, which expenses are always debit, so we've debited depreciation expense $300, we need to credit something. We don't directly credit the asset when we're depreciating, right? So that's a little different from prepaid supplies and prepaid rent, because you may recall when we expense those current assets, we actually just deplete those assets. We just write those off and we do our credit to prepaid rent, or we do our credit to supplies, and we reduce the asset. But in the case of a long-lived asset like a building or furniture, we don't write it off. What we do is we keep that asset on the books at its original cost. So in this furniture, that would be $18,000. So whenever you looked at the furniture account, it would say $18,000. But our credit is to this accumulated depreciation account. And so that way we're going to, just like it says, accumulate the depreciation so that we can use that to offset the asset value that's on the books for the furniture. So if you were to look at the balance sheet or the trial balance, you would see furniture $18,000 and you see accumulated depreciation $300, and that way you can subtract those and you can say, okay, well, the actual value of that asset is $17,700, but it's more informative this way, right? Suppose you were looking at the balance sheet of a company and you saw $17,700 for furniture. If we had just directly taken it off of furniture, well, you wouldn't really know, like, well, how used up is that furniture? Is it like brand new furniture that's worth $17,700, or is it really old furniture that was originally worth $80,000 and now it's only worth $17,700? So this way, you can look at your balance sheet and you can say, okay, furniture $18,000, accumulated depreciation $300, that book value $17,700. Okay, well, that's fairly new furniture. It's still got a lot of life. It gives investors and bankers and people more information, right? That's what it's about. So they know, oh, that hasn't accumulated much depreciation, or oh, it's accumulated a lot of depreciation, right? It's just more informative to do it that way. So, the accumulated depreciation account is the sum of all depreciation expense recorded for the depreciable asset to date. Adjustments to the value of the plant assets are not made directly to the original asset account, so we do not violate the cost principle. Instead, the adjustment is made to a contra account called accumulated depreciation. So here's a category of accounts that we haven't really learned yet. Contra, C-O-N-T-R-A. That word means against, right? A contra account goes against another account. A contra account has an account balance that is the opposite of the normal balance of the related asset account. So clearly, if an asset, like furniture, normally has a debit balance, the contra account, accumulated depreciation, will normally have a credit balance. The net result of the cost of the plant asset less accumulated depreciation is called book value. The book value is the amount reported in the asset section of the balance sheet. The cost principle requires the plant asset to maintain the cost value in the asset account. However, the corresponding contra account is reported in the asset section of the balance sheet. The plant asset and corresponding accumulated depreciation accounts are netted, N-E-T-T-E-D. You net them out so that the depreciation value, i.e. book value, of the asset is reported properly in the asset section of the balance sheet. That was depreciation. Here you go. There's your example. Smart Touch Learning. Furniture, less accumulated depreciation, equals 17.7. This just goes in your asset portion. Let's talk about deferred revenue. So remember, deferrals mean something got paid up front and now we're accounting for it. Deferred revenues, as opposed to expenses, deferred revenues occur when a company receives cash from a customer prior to performing services or delivering a product. For example, an attorney requires a new client to pay a retainer fee of $1,000, yet no services have been performed. The attorney debits cash and credits unearned revenue to establish the liability. If the client decides not to use the attorney, he or she can request a refund. Upon performance of this service, the revenue will be recognized. So I know we've talked about this unearned revenue account. We've talked about it, I think, in the context of like building a custom surfboard and you require the money up front, right? But you haven't done the work yet. That's what we're talking about. You collect money up front before you do the work, so you owe the person some work or a service or a product, right? You owe. So that's a liability. Unearned revenue is a liability and it goes on the balance sheet and only the balance sheet, never the income statement. All right, so talking a little more. Let's look at an example. Deferred revenues arise when the company receives payment from a customer prior to services being performed or products being delivered. Since the company has not yet performed the service or delivered the product, the customer has a right to request a refund. Therefore, the company still owes the customer either performance or money back. Therefore, the prepayment from a customer is considered a liability. So here's an example. Collected cash for future services. So cash debit, increase that asset. Unearned revenue credit, increase that liability. So now you've got a liability on the books. Well, hopefully at some point you're going to do the service, right? In our example, Smart Touch Learning initially recorded a liability of $600 for unearned revenue. Between the time the payment was received and the end of December, Smart Touch Learning performed 1/3 of the services, which means it has earned $200 of the original $600 received from the customer. All right, 10 days divided by 30 days equals 1/3. Times 600 equals 200. Therefore, 1/3 or 200 is required to be recorded as service revenue. So here's how deferred revenues work. You collected that money up front, then you did the service. All right, so now you do get to record the revenue. You get to recognize the revenue, right? That word, recognize the revenue. So here's how you do it. Well, you no longer owe them that part of the liability, right? You've paid off the liability by doing the service. So you get rid of the liability with a debit, and you increase revenue on the right, remember, always. So decrease your liability, increase your revenue, and now you've accounted for that deferred revenue. All right, so now at this point, class 7, so if you're in the Tuesday, Thursday class, this is the end of Tuesday, Thursday class. We're going to stop and pick up with accrued expenses for class 8. But if you're in Monday, Wednesday, Friday class, this is the end of class 10A video, but you'll want to still go ahead and watch class 10B video because you still need to learn about accruals. All right, so class Tuesday, Thursday people, I will see you again in the video for class 8, and class Monday, Wednesday, Friday people, go right now, or take a little break, and then go on to video 10B. All right, everybody, have a great day.